Hello, hi, and welcome to the market update from 16th to 20th of September 2024. So let's start with the world economy. The UK Bank of England held its key policy rate at 5%. This was cause of the headline inflation which came at 2.2 in the August, which was unchanged from the month of July. But year on year, the prices have been increasing in services. This is closely watched by the Bank of England because of the wage component, which we can do 5.6% from 5.2% in the previous year. There was Now we move to the US economy. Before we move to the biggest news that the US Fed announced on the rate side, there were two major data points that we definitely need to look into. The US retail sales ticked up by 0.1% from July to August. It is to be noted that in the month of July, it had jumped the most in the month of July. On the other side, the jobless claim, as reported by the Labor Department, had slipped by 12,000 number to 2,119 for the week ending on the September 14. That's a fewer than the economist expected number of 2,30,000 as per the new filings. So coming on to the biggest news of the last week on the economic front, the US Fed finally reduced its key rate, and it was unusually large, half a percentage point, which they reduced, causing the rates to lie between 4.75 to 5%. This was the first rate cut that had happened in the last in more than 4 years. The Fed had proactively approached this increase with the likelihoodness of the soft landing, as the projected string of rate cuts will lower the borrowing cost for the consumer as well as the business over the time, helping to accelerate the growth in the coming year of 2025. If we look at this rate cut of 0.5%, this amount of rate cut has been done by the Fed earlier two times, and whenever those conditions that has happened, the conditions were not very conducive. The Fed was forced to cut those rates, but this time it was different in the sense that Fed cut its rate because it did not had to, but because it wanted to. So that's the difference in the context of this rate cut. At 0.5% rate cut could be construed as a very negative impact. By a lot of market readers, but the Fed was in a position that they could cut this by 0.5%. They were not forced to do that. If we look at the dot plot of the interest rate projection, which shows there's an expectation of additional 0.5% in this towards this end of the financial year. 0.25% may be happening in the month of November, and another 0.25 in the month of December. There's another expectation of another 4 rate cuts that would happen in the year 2025, and then 2 rate cuts in the 2026. Let's see how that pans out. Now moving to the US 10-year Treasury bond yield. The 10-year Treasury bond yield was stable, rose a bit from last week from 3.6 to 3.744%. This large rate cut was given a cheer by the markets, where the US market ended in positive. They were in a green zone by 1.4%. The Asian markets also gave a cheer to this rate cut, where we could see 1550 was up by 1.9%, Nikkei was up by 1.93%, Hang Seng was up by 4%. There was some problem in the European market, which ended on a rather flattish note, not too negative. If we look at the oil market, the oil prices in the last week was in an upward trajectory, and it closed at $74.72 a barrel, up by 3.52% as compared to the last week. So this upward movement was because of the three major reasons. There was an oil supply disruption which is caused by hurricane in the U.S. Gulf of Mexico. There was also expectation that the rate cut by the Fed would cause the consumption or the revival of the business economy in the US. So the oil prices started in there. And the third and the final point is the East Mediterranean crisis that we are witnessing for long. And the last week was again there was a major crisis that has happened in there. For the gold was almost flattish, trading at 74,014 per 10 grams. For the week's FII and DI flows, we saw that FIIs were there was a lot of volatility in the market because of the Fed rate cut announcement. So it was sure that there's going to be a rate cut. The markets were discussing at what point they would be doing it. So, but towards the end of the week, the FIIs give a cheer to the announcement of 0.5 percentage point rate cut, and they bought net 11,517 crore worth of equity in the Indian market, whereas the DIs were net seller at 3,300 crores of worth of equity. This impetus gave markets to reach their new high in the week. Sensex and Nifty touched made a new high, and they were up by close to 1.9 to 1.71%. Nifty Bank was up by 3.57%. This could be highly related to the FII's flows, because whenever the FII money comes in, they are more attracted. They are more attracted to the Nifty Bank or the large cap part of the market. Whereas if we look at the DIS flows, which were negative towards the week, we could see that it's happening in the same was happened in the mid cap segment, whereas the mid cap segment was flattish. It was up by 0.3%. Whereas the small cap was close in a negative by 0.89%. So coming out to the PE valuation, how the PE valuation is looking, the Nifty 50 trailing PE had reached 24%, which is 2 years high now at 2 years high, but below a 5 years average. Nifty mid cap 150 trailing PE is at 44.9 at 2 years and 5 years high. Nifty small cap 100 trailing PE is at 30.1, nearly 2 years high and just above 5 years average. So the market valuation in the mid cap and the small cap is still frothy, still a segment that we can avoid. And the Nifty 50 trailing Nifty 50 is or the large cap index is much better position as compared to the rest of the market. If you look at the Buffet indicator, it shows that the markets have again gone into a moderately overvalued zone, where the ratio has gone over 100, it is currently 112 to 0.37. Now we move to the Indian bond markets. The Indian bond 10-year government bond was relatively stable at 6.877% of yield. There was a blip in that we could see in the 2 years to 1 year the yield curve, where there was a yield change from this was a flattish 16.7 bps. And the long term and the medium term is still flattish in the yield curve. So that was all from my side. I hope you enjoyed the video. Do tune in to our channel, to like, share, subscribe, so that you can get the weekly updates from. Thank you.